Previously, inside the vault.
So, what exactly is the stock market? Anytime you buy shares, there has to be someone on the other end to sell them to you. And vice versa, when you sell your shares, someone has to buy them from you. The stock market is by far the best wealth building vehicle that anyone can take advantage of with the right knowledge and understanding. My favorite way to take advantage of stock market investing: options. Most people don't exercise option contracts. We trade options, meaning we buy in at a low premium and plan to sell the option contract back into the market to another investor for a profit. What's going on, YouTube family? It's your favorite headless YouTuber back at it again with a brand new video, and happy Labor Day. Today is a day to celebrate the people that truly make the world go round. All of you. Whether you're a school teacher, a doctor, a cook, or an exterminator, you serve a vital role in society because the truth of the matter is, someone has to do it and not everyone is capable. That leads us to today's Monday motivation. No work is insignificant. All labor that uplifts humanity has dignity and importance and should be undertaken with painstaking excellence. That comes from none other than Martin Luther King Jr. Now, today's video will be a continuation of our discussion on options. Using the Robinhood platform, we will discuss the options chain, bid, ask, and the bid-ask spread. And of course, as promised in the previous video, I will be giving you the $1 million secret to options and stock trading. So make sure you stick around for that. Before we get into today's video, I want to congratulate all of you that were able to take advantage of last week's trade alerts. 2 out of 3, not half bad if you ask me. The goal is, of course, to lose as little as possible, but as long as you continue to win more than you lose, you're still a winner at the end of the day. Now, if you want us to make more videos more often, please make sure you subscribe to the channel and turn on notifications so that you always know when we post new content. Without further ado, let's get it. Now, if you haven't watched part 1 for our stocks and options breakdown, please go do so now. The link is in the description below. I'll see you in about 14 minutes. Now, let's get into today's first topic, which is the options chain. So, what exactly is it? The options chain is a table that lists all of the options available for a stock and all of the important details that go along with those options. The elements of the options chain will be the same on all platforms. They will just be presented slightly differently. Like I said in part 1, we keep things simple. If it doesn't contribute to us making more money more consistently. And with that being said, we will briefly define what each of these elements are and what they tell you about an options contract. The expiration date, as we know, is the date that you choose for your options contract to expire. Remember that the time between the present and the expiration date is directly correlated to the value of the options contract. More time is more valuable since it gives more time for the stock to change in your favor. Option type, call or put. This is where you decide if you want a call if you're expecting the stock to rise, or a put if you're expecting the stock to fall. As we know, the strike price is the price you expect the stock to reach or surpass before the expiration date. Remember, we recommend choosing the closest strike for the direction you're expecting the stock to move. The last price, or the premium, is the price you'll likely pay for the options contract. The change is the percentage amount that option has moved since the previous trading day. Volume tells you how many of that options contract has been traded during the present day. Open interest tells you how many of that option contract is currently being held by other investors. Implied volatility is how much the price of the option is expected to move up or down before the expiration date. The option Greeks give you a detailed look at the different factors that influence the change in the options premium, based on things like the stock's price, volatility, and time left until expiration. While the Greeks can be helpful, the Greeks are not vital to your success in options trading. So we advise not focusing too much on understanding them and overcomplicating your understanding of options trading. Now, let's talk about the bid and ask. The bid and ask are how the option premiums are decided. To put it simply, the bid is the amount that you're most likely going to be able to sell your options contract for, and the ask is the amount that you're most likely going to have to buy into the options contract for. The midway point in between the bid and the ask is typically the suggested premium for that options contract. Just in case I may have lost you there, let's take a look at this example. At the top here, you'll see that Apple's current price is $154.29. Here, you see that I've selected a call with a $155 strike price and a September 10th expiration date. Here, you'll see that the bid is $1.24 and the ask is $1.29. Bear in mind that this is presented as price per share, and we know that contracts represent 100 shares, so in real money, that's $124 and $129. But we'll keep it to what we see on the screen for now. So if I already own this contract, I'd be more likely to be able to sell it at the bid of $1.24. And if I wanted to buy into this contract, I'd be more likely to buy in at the ask of $1.29. If you look a little to the right, you see that it auto-populated $1.27 for the price. Now, why is that? Because that's the midway point. That's the midway point in between $1.24 and $1.29. Look at the midway point as the compromise between the buyers and sellers in the market for a price that they both can agree on. Because Apple's bid-ask spread, or its difference between the ask and the bid amounts, or in this case, 5 cents, because $1.29 minus $1.24 is 5 cents. Because this is so small, the midway point has a higher chance of being fulfilled by the buyers and the sellers. So if you were to place an order to buy or sell this contract, you're much more likely to have someone willing to sell it to you or buy it from you at the midway price point. Okay, so let's take a look at a much wider bid-ask spread. As you can see in this example with this $170 call for September 17th for LGIH, the bid-ask spread is much wider, with the bid being 35 cents and the ask being $1.85, making the bid-ask spread $1.50 because $1.85 minus 35 cents equals $1.50. Remember, these premium numbers are presented as price per share, and we know that option contracts represent 100 shares. So in real money terms, this options bid-ask spread is $150 compared to the $5 bid-ask spread in Apple's example. The midway point for this LGIH option contract is $1.10, which is less likely to be fulfilled by the buyers and sellers because they have to compromise a lot more on this transaction. Now let's apply this concept to a real-world example. Imagine you're selling your car and you're asking for $1,850. I'm in the market for a car like yours, but when I look it up on Kelley Blue Book, it says that it's only worth $350 in its current condition. In this case, the ask is $1,850, and my bid based on Kelley Blue Book is $350. The meet me in the middle price would be $1,100, making us both have to compromise on giving up $750 on what you want to sell it for and what I want to buy it for. In other words, I would be paying $750 more than what I think it's worth based on Kelley Blue Book, and you would be selling it for $750 less than what you originally wanted to sell it for. Now, how likely would you expect this transaction to go through? Not very likely, right? Of course, it's not completely impossible, but your chances are much thinner than if the spread was smaller. Take the same example, but let's say you wanted to sell your car for $1,290. And when I look it up on Kelley Blue Book, it says it's worth $1,240 in its current condition. In this case, the meet me in the middle price would be $1,265, making the compromise only cost us both $25 on what you want to sell it for and what I want to buy it for. So I would only have to pay $25 more than what Kelley Blue Book says it's worth, and you would only have to come down $25 on your price that you originally wanted to sell it for. Now, this transaction sounds much more reasonable, right? That is the importance of a reasonably tight bid-ask spread when it comes to options trading. The important thing to remember is that every transaction in the market is an exchange with someone else. So anytime you buy shares or options, there has to be someone on the other end to sell them to you. And vice versa, when you sell your options or shares, Someone has to buy them from you. Time for that $1 million secret to stock and options trading. C.A.P. That's right, C.A.P. And no, not the type of cap that you're probably used to. This C.A.P. stands for compounding, averaging, and patience. These three concepts are at the core of every successful seven-figure trader. Compounding simply is changing your perception of your returns, looking at the percentage gains rather than the dollar gains. It's realizing that being able to make 10% a month may not sound like a lot, but it actually equals a gain of 313% for the year. Imagine being able to triple your money every year. It's understanding that 10% of a $100 investment may only be $10, but that same 10% of a $100,000 investment is $10,000. The key is to trust the process and realize that this isn't a get-rich-quick scheme. Run the marathon, not the race. Averaging is what we briefly discussed in the previous video about scaling into your trades. Basically, the idea is to accept that your first entry on most trades, if not all, will not be the best entry. Just because you buy a put today doesn't mean the stock would immediately start to fall tomorrow. The concept of averaging in is your cheat code to the market. For example, our favorite stock, XYZ, looks ready to move up, so we decide to set aside $500 for XYZ. XYZ is currently priced at $50. Instead of using all of the $500 that we set aside to buy 10 shares, now we decide to average in. So our first entry is at $50. We decide to buy 4 shares for $200. XYZ then falls to $40. We still have $300 set aside to invest in XYZ. And we look back at our analysis and it still says it's going to rise. So now we decide to buy 7 shares for $280. Now we have $480 invested for a total of 11 shares. If you divide the $480 by the 11 shares, you'll get an average price of $43.63. What this average price tells us is that now all XYZ has to do is rise above $43.63 for us to be in profit. If we were to put the entire $500 in at $50 on our first entry, we would have to wait until XYZ rolls back to and above $50 to be profitable. By averaging in, we got a better average price and we don't have to wait for a full reversal to be profitable. This works the same for options. You just average into the same option contract as the trade goes against you. The key is to have a budget for how much you're willing to put into every trade before you buy any shares or contracts. That way, you don't average yourself into a hole too deep to get out of. Remember, you have to be able to accept when you are wrong and take your losses and learn from them. The third and probably most important part of this formula is to have patience. Here inside the vault, we spell patience with P-A-Y because patience pays. You can't rush the market to do what you want it to do because the market is always going to do what it wants, regardless of what any of us think we see. Always just do your due diligence, trust your analysis, and just give yourself enough time. It's less about timing the market and more about your time in the market. As always, remember to invest or trade responsibly. So that'll do it for today's video. If you've enjoyed this video and want us to make more videos more often, be sure to hit that thumbs up button below and subscribe to the channel if you haven't already. Also, comment below your thoughts and questions to let us know how we can continue to improve this channel. This channel and all of its content is made for you. Thank you for watching this video, and I'll see you in the next one.